Okay, thanks, everyone. I think we should start. It's 11:15. So for this week, we're just going to do as usual. Whenever we finish strategy presentation, we're just going to give you a summary of what we presented on Saturday. So hopefully it's not too boring for those who've already attended on Saturday. So apologies for that. So we released our Singapore fourth quarter strategy report on Friday. It's basically investing in inflation, because what we see is that inflation pressures everywhere, and what are the sectors and teams that we should be playing. Next slide. Next slide. Okay, and we were just going to go straight into the macro themes. The first theme that we see is basically inflation is creeping up everywhere. If you look at the table on the left, which is the liquidity or US money supply, if you recall, during the global financial crisis, the Fed conducted QE, which is the buying of treasury bonds and mortgage bonds. But you notice that money supply didn't really increase. I mean, there was a jump, but after that it stayed kind of flat at increase of around 1 trillion, roughly 1 trillion a year into the US economy, because most of the money was really just hoarded up. Most of it was kept as bank reserves. But right now, when you looked at the 2020 QE4 and together with the fiscal stimulus, you notice there's a big jump in money supply. This is important because this means this money really goes into the real economy to buy goods and services, of course. That's why you see retail spending in the US now at record highs. One of the reasons. And if you look at the next bar, which is 2021, it's only 1.5 trillion, but this year to date, I think up to August. So we could probably hit another 2 trillion injection of liquidity. And all this liquidity means it's going to put upward pressure on inflation, because the demand will be elevated. The other reason why we see inflation is much higher is also, if you look at the table on the right, which is the CRB index. I mean, there are many indexes to measure commodities, but we just took this. So you can see that it is a broad index on all the commodity prices. And you can see that there's a high chance it's probably going to be a record highs. Of course, there's other people might actually measure it as a real commodity price index, but I think we just use this as a nominal value. You can see that it's likely to hit a record highs. Next slide. And we see many cost pressures elsewhere. I mean, we didn't include, of course, there's also wages and so forth. Even cotton price, I just read, is like an all-time high, or a decade high, I think. In terms of the table on the left, you see that there's pressure on manufacturers, which is the PPI. So PPI measures like CPI, but this is the PPI means the cost that's faced by manufacturers. And like we illustrated earlier, just to give you an example, like a real example, when we attended Del Monte's recent results, they mentioned that because of all the cost pressures, food canning, tin prices are also record high, because Del Monte is one of the leader in canned food, canned fruits, canned tomatoes. So they are actually facing a 60 million impact on material costs. Some of it can be alleviated by cost efficiencies, manufacturing efficiencies, but a lot of it has to be passed on. So that's why they actually have to raise prices. Otherwise, 60 million is a big hit. When this company makes 20 million a quarter, so so they have to raise price. So this is just to give you some real world flavor of kind of cost pressures faced by a typical manufacturer. The other, of course, there's also transport costs. You can see on the right. This is the shipping rate. If you want to ship something from China, let's say you take the red line from, just approximate from Shanghai to Rotterdam, you notice that it used to be 2,000, then now it's almost 14,000, 15,000. There are two implications for this. The joke is that the shipping cost per container, if the container costs 15,000, it could be actually worth more than the goods inside. But the longer term implication, which hopefully doesn't fan out, is that if it's so costly to ship, manufacturers might decide to just ship their production into US. If it's so costly, I might as well just put a plant into China. But again, whether this sustains is unclear, but this is one of the longer term risks if shipping rates continue to be at such elevated levels. Next slide. So what's the implication of this? So if you notice from this is just a long-term chart from 1960 to now. You can see this is a chart of bond yields, or basically interest rates, which is the blue line, compared to CPI, which is inflation. So if you notice, for many, I guess, decades, the investors always want some real returns. That means they want interest rates that's higher than inflation, which is the red line. But right now, you can see this abnormal spike in CPI. Of course, the argument now is this is just temporary, but if it's not temporary and it sustains or even drops a little bit, you can see that the red line is unusually too high compared to bond yields or interest rates. So we just think that there's going to be upside risk or upward pressure towards interest rates. And you're beginning to see treasury bond yields start to climb. I mean, we'll discuss a little bit more when we talk about gold. Yeah. Next slide. So that was the first theme. The theme is about higher interest rates coming and also inflation. The next theme is just the reopening trade, which we think is still on track. If you look at this chart, I mean, the vaccination really took place only early this year. And if you can imagine, a year ago, 12 months ago, we rolled back, we weren't even sure there will be a vaccine. But right now, globally, I mean, roughly, it's probably about 30%, 34% of the population has been vaccinated globally. And by year end, we think it could hit 40, and by August of next year, it could hit 82. Again, this is just statistics. I mean, we're just doing some linear. You can see the chart is just upward sloping linear because we're just taking the vaccination rate now and extrapolate it. Of course, it may not be so high. There's always some pushbacks. But you can see that the developed countries like US and Europe is at high, almost 80%, 70, 80%, 65 to 70% by end of this year. So this gives us hope that borders will continue to reopen, and the reopening of the global economy is still on track because vaccinations is still rising. Next slide. This is the typical chart we show every week, but I won't go through this, but you can see the blue line, cases are coming down sharply, and also more importantly is, of course, mortality is a new low for 2021. Next slide. Okay, this is just our final slide on the themes. So in terms of the valuations, what we're just trying to say is that right now, the STI based on current earnings 1 year forward is about 14 times, which you notice on the chart on the left, it's around average. The green line is the average through the last 10 plus years. But what we're saying is that the earnings hasn't factored in reopening. I mean, most analysts won't factor in a jump in Genting earnings or even SIA earnings because the border reopening is so unclear. But what we think is that there's an upside optionality, which means that earnings hasn't priced in borders reopening. So we think the markets it's not expensive, considering that there's some optionality that there's a reopening on track. The table on the right is just to show you, interest valuations may be 14 times, but how does it compare to interest rates? So we are also again at the fair level where if you flip the earnings yield, which is the reverse of PE over interest rates, is roughly about a 5% increment. So compared to the current interest rate environment, we are around fair. Next slide. So I'll move on to Weiren, who will take us through the summary of some of the technical views. Yeah, Weiren.
Right, thank you, Paul, for the macro update. So just quickly go through the technical view. So, yep. Okay, so basically what I shared during the strategy, some of you have heard it. My views still remain the same. The STI weekly chart over the mid to longer term are expecting intact of the bullish uptrend, despite a pennant, consolidation period. So you can see that why I made this statement is because I mentioned earlier on the strategy as well. The series of higher high, high low has been made, and then while price has already broken upside of the downtrend line of the weekly downtrend line. All right. Despite a pullback, I think price remain the SDI remain elevated above the 3,000 psychological support, which are marked by the support zone 1. Despite sluggish up move, price remain rebounded and grounded or above support zone 1. So right now, I think I expect some sort of like short-term upside to 3,002. To the upside, and then from there we shall see if it breaks. But on the longer term aspect, I'm expecting STI to target 3,004 in the midterm, and then subsequently 3,005 in the longer term period. All right, the 3,004, I think likely by end of this quarter or early quarter next year, 2022, we might be able to achieve that target. So I move on to the daily chart. So daily chart, I just want why the daily chart is because I just want to show you a very a zoom in view on the daily chart as well. So first start off with the Ichimoku indicator. The Ichimoku indicator is showing a removal of the bearish trend track. Right now, the Ichimoku is showing a very ranging market. Not a very fantastic signal, but at least we know that SDI is the bearish trend of SDI has a significant drop lower based on the Ichimoku. And beside that, you can see that the price has really been trending above the Tenkan Sen and Kijun Sen crossover, and the black line, you can see that the Kijun Sen is actually what do you call trending above the candles. The only concern is Senko Span A still remain below Senko Span B with a tick Kumo. But rest assured that if once price already break above the Senko Span B, Senko Span A will form a bullish Kumo twist in times to come. So this is what I have viewed in light of the SDI. So the next chart is showing a very strong price action. I removed the Ichimoku indicator. You can see that price, I think, as of now is trending slightly above the neckline resistance, which is a good sign because it confirmed the breakout of the inverted head and shoulder. Let's take a step back. We can see that the falling wedge has been fulfilled. Means that the bullish reversal to the upside likely is to come. So if the price rebound and then close above neckline resistance line, all right, we can see that there will be a series of higher high, higher low, the first series, and therefore we can see that they will be targeting the upper bound of the panel formation at 3195, maybe a slight upbreak to 3002. That is highly possible. Then look at the MACD. MACD is currently, if the price is going up, I think histogram is showing a very strong closure above the zero line, means that it is a leading indicator within the MACD. It's just that we just need to wait for the MACD and signal line to cross above zero to further cement and enhance the confirmation and continuity. Okay. So I'll move on to the two counters that I think that is kind of like a very strong bullish upside. First of all is Rex International. So why Rex International is because if you look at the oil futures, light crude oil has actually touched $80 per barrel. All right, that's actually a very good sign going forward. And then you can see that for the technical price action, all right, for Rex, okay, bring back to Rex. Rex is actually has already broken out the ascending triangle, which is a good sign going forward for Rex. First of all, I think this is a bullish continuation despite a pullback back within the ascending triangle, but prices rebounded the second time on September itself, and then goes up. As of right now, it has already closed successfully above the 2.5 psychological resistance with a very strong bullish candle. Bullish crossover is cemented right now based on the chart that I've seen. So I think that Rex has still further upside going forward. So the last on my slide is Wilmar International. Wilmar has been going on down on the very downtrend very strongly since the start, since at $5.60. But currently, I think price is looking to have a rebound despite today there's a strong selling at $4.40. But as long as it stays elevated above the neckline resistance turn support, I think we are kind of safe. All right. First up, I think the intermediate downtrend has already been broken, confirmed that there's a serious higher high, higher low. So the short-term target, we're looking at $4.60 to $4.70. Looking at the Ichimoku indicator, we are showing it is showing 2 out of 3 golden cross signal. First up, the Tenkan Sen and Kijun Sen have successfully crossed with the morning star formation. This bullish candle closed above the Tenkan and Kijun Sen. The next one is the lagging span has already closed above the candles. And lastly, the head and shoulder has been confirmed. The only thing is Senko Span A need to cross above Senko Span B, and price traded out the cloud. Then we can confirm that Wilmar is currently going very strong. Okay, so with that, I pass on my time to Glenn to share about the banking sector. Glenn, to you.
Thanks, Aaron. So for the banking sector, our theme would be strengthening economic momentum. And if you look at the chart on the left of the screen, we can see that the PATMI, which is the blue bar, has dropped significantly in 2020. And this was due to the COVID-19 pandemic. However, if we see it start to return to pre-COVID levels in 2021 and 2022. We hence expect 2022's PATMI to exceed 2019's pre-COVID level. The bank's increased PATMI is largely boosted by strong economic momentum as we recover from the COVID-19 pandemic and enter a new normal, as well as rising interest rates, which would increase the bank's NIM and ultimately their profits. So besides the bank's interest income growth, we also expect the bank's fees and commission to grow 22% on a year-on-year basis for full year 2021 and to grow 18% for 2022. Loans growth has also been strong and shown recovery. We expect loans growth of about 5% on a year-on-year basis for full year 2021. This is more on the conservative side, but we think that there will be an upside to this. Allowances reversion is also expected to continue. If we refer to the graph and the huge dip in 2020, there was actually a large increase in the bank's allowances for that year, close to 6.7 billion. We expect allowances to lower to around 1.7 billion for full year 2021 and to 1.5 billion for 2022. We have also looked into the three banks' exposure to China, and as at first half 2021, they total around 134 billion and account for less than 14% of the bank's total loans. However, this is not much of a concern as we believe that these customers are primarily state-owned entities and large overseas corporates. Loans under moratorium for the banks also account for only a small percentage of the bank's exposure. In fact, less than 3% of total exposure. We are also not that worried about these loans under moratorium, as majority of them are secured by collaterals or government guarantees. Lastly, for dividends, we expect the dividend yield to continue to improve. Referring to the chart, we can see that the dividend payout, which is the red bar, is closely related to the bank's PATMI. And with the PATMI expected to increase, we also expect the dividend payout to increase accordingly. We expect dividend yield of about 4.5% for full year 2021 and 4.9% for 2022. So that's all I have for the banks. Let me hand over to Natalie.
Thank you, Glenn. Good morning, everyone. Okay, so we'll start off with the property sector. Okay, for the property sector, we are seeing healthy demand amidst moderating prices. In the graph on the left, the all private residential price index, as well as the HDB resale price index, continues to grow, although at a slower rate. Private new sales for year to August came in at 9.4 thousand units, forming 91% of 2020's sales. We estimate that this year's transactions will come in around 12,000 units. In the first quarter of 2019, there were about 37,000 unsold units in the market, and the market was nervous about inventory overhang leading to lower selling prices. Currently, there are about 16,000 unsold units in the pipeline, which translates to about 1.5 years of sales, which should help support prices. We maintain our overweight recommendation on the property sector as valuations at 40% discount to NAV still look attractive in our view. Additionally, we prefer developers with high recurring cash flows and visible development pipelines. Next slide, please. So some of you may be interested to know how the REITs perform in rising interest rate environment. So rising interest rates will hurt REITs in general. In the graph on the left, the shaded blue areas are the periods where interest rates are declining, and we see that the REITs generally outperform the market in these situations. The graph on the right shows the inverse correlation between the REIT index and the 10-year bond yields. We see that the declining interest rates will cause the FTSE REIT index to rally, and conversely, spikes in interest rates, denoted by the shaded red areas, result in downward price movements for the REIT index. As REITs generally maintain a 65 to 100% interest rate hedge, and based on our sensitivity analysis, a 100% increase in interest rates, 100 basis point increase in interest rates will reduce DPUs for REITs under our coverage by about 0 to 5.4%. Next slide, please. Now moving on to the office subsector. The office sector is facing a structural decline due to right sizing and implementation of hybrid work arrangements. This has resulted in the tenants market. Many tenants are figuring out their space needs under hybrid working conditions and prefer to have some flexibility and optionality. Many have asked for expansion as well as contraction clauses in their leases. As such, net absorption for the CBD was negative 0.5 million square feet for the first half of 2021, compared to the positive 0.8 million square feet of absorption in 2020, where we saw a flight to quality when rents declined. However, we are seeing a quarter-on-quarter improvement in leasing activity. The office market is supported by lower oncoming supply. 0.8 million square feet of CBD supply is expected to come on over the next 5 years. And this is lower than the 5-year historical average supply of 1 million square feet. The redevelopment of Fuji Xerox, AXA Towers, and Central Mall will take 1.2 million square feet of supply offline in 2021 and 2022, reducing the competition for tenants and resulting in displaced tenants who will need replacement offices. Next slide, please. We are overweight on the industrials. Industrial stock comprises of business park, factories, warehouses, and data centers, which attract tenants in the growth industries such as tech, biomedical, manufacturing, and logistics. We are forecasting 8.8% of DPU growth for industrial REITs under our coverage on the back of less impacted FY20 DPUs. Macroeconomic data remains supportive, with PMIs in its 15th month of expansion. We are on the industrial. Yeah, thank you. Okay, so early share price recovery has also helped the industrials with acquisition. Despite these positives, industrial REIT managers caution that near-term pressures may continue on rents. Next slide, please. Now moving on to the retail sector, we are seeing recovering tenant sentiment as seen by the rebound in occupancy. First half 2021's net absorption was positive at 12,000 square meters versus the negative 72,000 square meters in 2020. As REITs continue to outperform the market with occupancies above 96%. We prefer suburban malls as we expect them to remain resilient regardless the default work situation. Suburban malls benefited from higher daytime population when work from home was enforced. And as work from office gradually returns, the higher transient footfall from the working crowd should still result in incidental spending from commuters as these malls are located near transportation nodes. Central malls should benefit from the return to normalcy, such as the return to office, easing of restrictions on group sizes, as well as the return of tourism when the borders reopen. Okay, next slide, please. Lastly, for hospitality, in terms of outlook, digitalization efforts should help reduce manpower costs, improving margins and hastening recovery. We see potential upside from revenge travels, which could potentially kick in 2023 and 2024. We may also see some polarization towards large hotel chain brands as travelers try to tap on loyalty and rewards programs. Two of the hospitality S-REITs have expanded their mandates to include long-stay asset classes, such as PBSAs, purpose-built student accommodation assets, as well as rental housing or multifamily assets. So this should help to increase, give some stability to the hospitality portfolio, which tends to be a bit cyclical in nature. Okay. Last of all, due to the high vaccination rates in Singapore, we think that Singapore could potentially benefit and be one of the first to benefit from border reopening. So that's all from me. I'll now pass the time back to Paul.
Thanks, Natalie. So we'll just run through some other slides on sectors, but we're going to predominantly focus on energy since that's the so-called talking point right now. So the table on the chart, right, the chart on the left is just shows you crude price and inventory levels in the US. So if you notice the US crude inventory, which is the blue line, and the Brent crude price, they tend to move quite in line with each other. I think when inventory is at the lows of maybe 350 million, we saw that oil prices was as high as $100. I mean, hopefully it doesn't go back to that levels. But then you can see that as inventory tends to rise, which is an inversion. I mean, it actually the chart actually when the blue line goes down means actually the inventory is rising. So notice that when inventory rises, the crude price will actually come down. So what we're just trying to say is that the demand for crude price is actually well supported, obviously by the demand and supply situation. And as we go into this reopening phase, especially with international travel, I think demand for oil could actually increase, especially with maybe jet fuel and travel in general. The only thing that could be the only pushback or the unknown is we are beginning to see the US shale producers. It's not on the chart, but we're beginning to see the US shale producers start to increase production. I think the first time in several months, the last 2 months, you saw shale numbers start to move up, because the last one over a year they will spend all the money just on buybacks and repaying debt. But right now we can see them, we can see production increasing. The table on the right, the chart on the right is just a reflection on the palm oil price. We saw the last few days palm oil shares recently spiked up significantly. One of the reasons is that is due to the red line. So the red line is palm oil price. So palm oil price actually hit an all-time high of 5,000 ringgit per metric ton. One of the reasons is because of the blue line, which is supply. So production has been coming off, but I think there's a bit of maybe a bit of speculative element here, because you can see that the last time the blue line was so low, palm oil didn't drop so much. But there are two reasons here for the rally of palm oil. Firstly, investors are just using it now like an oil proxy, because what happens is that when oil prices are high, demand for biodiesel will also surge. So there is some link to oil prices, number one. Number two, of course, palm oil prices were also very under-owned. So you saw the share prices spiked up recently. And the third thing is supply, which is the blue line. So supply has been contracting. It's an inverse chart. So when the blue line rises, means supply is contracted, production is coming down because of the pandemic and the shortage of 30,000 plus workers. And you need all these workers to kind of harvest the fruits. It can't be done manually, and it's quite a tough job actually. Tough work, sorry. So as a result, the investors still think that palm oil supply will still be kind of low. And more importantly is that if it continues to be seen as an oil proxies, the upside for palm oil will in a way kind of be linked to the direction for oil prices. Next slide. The next one we had was just offshore marine, since we're on this energy team. So the red line basically is all the oil capex. So we took capex of Shell, Total, Saudi Aramco. We just combined all the capex, so all the major. I think we excluded Aramco because the historical numbers weren't so high. But we have BP, Esso, Total, not all the Sinopec, all the major oil majors. They are listed. We took all the capex, and then you can see that the capex for the oil majors tend to trend in line with Sembcorp and Keppel Corp's, the yacht order book. So when the red line drops, when all capex down, the capex is also come down, obviously. But what we think is there is some chance. I think if you look at 2022, the oil capex is actually up, and it could actually climb up further if oil price continue to rise, because these are still forecast by the market. So we think there is some chance of a rebound for the order book for both Sembcorp and Keppel Corp Marine. Consider it's at such a depressed level right now. And next slide. Okay, our last chart on sectors, again, just on the energy inflation theme, is about gold. There are probably hundreds of people with all kinds of view on gold. So let us, I don't know what he has asked us, but let's just share our gold view. So if you look at the chart here, you can see that gold price tends to rise when there's a lot of global negative debt, which is mainly a lot of European sovereign debt, even some corporates, where they issue debt at negative interest rates. So intuitively, what this means is that if there's so much negative debt, rather than I park my money in negative bonds where I actually have to pay money, it's better for me to just park it in gold, since they're like zero. You can consider them like zero interest, zero coupon bonds. But you notice that the gold prices hasn't moved much because the amount of negative debt continues to decline. So our view is that gold is actually a good hedge if you actually have a lot of bonds. We think that gold might rally if there's a bond bear market. What we mean, one of the reasons that if investors are convinced that bond yields or interest rates will kind of rise at elevated levels, then the only way to protect yourself is the money will flow into gold. But having said that, it's also something to be very careful, because as you've seen in 2013 or 2014 when we had the Euro sovereign crisis, and with so much debt out there, even the US national debt is about 22 trillion. So you can imagine if there is a collapse in bond prices, the impact on global wealth, there's 22 trillion of wealth out there, or capital can be disrupted. So it's something to watch, but it's not something we price in. But what we're just saying is that the way we think gold prices can rally is there is a bear market, a real significant bear market in bond prices. Yeah. Okay. Thanks. Next slide. I think we move on to stock picks. Next slide. Okay. This is our absolute 10 model portfolio. The two names that we added is HRNet and City Development, which Natalie will elaborate later. The part what dragged our performance, I think we were down about 3+%. The 2+% you see there is because we included the new inclusions. It's mainly because of our reopening place. I think stocks like Escort REIT got hit because we entered to further social distancing social restriction measures. And also the other one that hit us was also like Q&M, Fraser Center Point, Comfort. So all these were hit by as we dial back on the reopening. The table on the right is just to show you how we compare with STI. Again, this is just a illustration only, excludes brokerage, dividends, and monthly rebalancing costs. The stocks that we took out is Ascendus REITs and also Capital Land Investment. The only nuance I can add is that unlike maybe other funds, what we do is every week we get questions like what we do right now. Every week we have this model, and every week we're actually being questioned whether our recommendation still holds. So probably there's something you won't get from anywhere else, I guess. Next slide.
Thanks, Paul. Yep, thanks. So our pick for the banks would be DBS, and the theme is interest rates tailwinds. So for DBS, they have this excess deposits of around 59 billion. And if you look at the chart on the left, it shows the DBS NIM against the SIBOR. And we can see that they are quite closely related. And with this, if a rise in the interest rates, the bank's NIM would follow. Therefore, if the interest rates are to rise, we expect that DBS would benefit as they have this large excess deposits. And we also expect NIM to increase. So for full year 2021, we expect NIM to be 1.47%, and for 2022, 1.48%. And this boost in earnings were also from an increase in fees and commission, which rose 27% year-on-year, and was led by a strong growth in the wealth management fees, which grew 31% year-on-year. With an improving economy, fees and commissions are expected to grow, and we expect a growth of about 15% for full year 21 and a growth of about 10% for 2022. The bank's AUM has also increased by 14% year-on-year for first half 2021 to 285 billion. And we also expect this growth to continue. There was a broad-based loan growth of about 3% in 2Q21 and a growth of 6% for first half 21. This growth was led by the trade and non-corporate loans. We expect this to continue, and we expect loan growth of 4.4% for full year 2021 and growth of 5% for 2022. With their asset quality stable, DBS was able to further write back general provisions of 85 million in first half 2021. So in light of this, we have lowered the total provisions for full year 2021 to 309 million from 772 million. And we can see that in FY22, it was actually almost 3 billion. So with this lifting of the dividend cap by MAS and the return to a pre-pandemic dividend payout, we also expect dividend yield to improve to 4.5% for full year 2021 and to 5.1% for 2022. CET1 for the full year 2021 is expected to be 14.2%, which is still above the bank's optimal ratio of 12.5 to 13.5%. And this high CET1 ratio could also pave the way for an increased dividend payout. I'll now hand over the time to Vivian.
Thanks, Glenn. So I'll be first covering on LHN, which offers flexible, affordable, and adaptable spaces. So basically what they do is that they will secure the master leases for these old and underutilized properties, or also acquire them through joint ventures and revamp according to the latest trends. Firstly, under industrial properties, they offer work plus store outlets, and they are seeing full occupancy levels at these spaces, and 70% is occupied by e-commerce tenants. So we attribute this high demand to the surge in the online retail sales since the start of the pandemic. And year to date, online retail sales have been up by 21%. So for work plus store, there has been for the work plus store, they offer flexible lease terms and also flexible upgrading of the storage spaces. So for example, if you want to start an online business, it is the most affordable option as compared to renting an entire industrial space. And for the expansion, you could easily upgrade from, let's say, one space to 2 of such storage spaces. And other than that, they also have photography studios where you could hold Facebook Live and Instagram Live sessions to engage your customers. And to improve the client's experience, they also offer delivery and car sharing services at their premises. So the picture on the top left is an example of the newest Work Plus Store outlet that was recently launched about a few months back, and it is the biggest property in the portfolio to date. Next, moving on to residential properties, they offer the Koliwu co-living spaces, under which they have also seeing full occupancy. And interestingly, there has been an increasing demand from the local young professionals, also due to the pandemic, as more people are preferring their own living and working spaces due to the prolonged work from home and stay at home trends. For FY22, we are expecting an addition of about 200 keys, which represents a 25% increase. And just last week, they announced the new acquisition of a property for the Koliwu portfolio under a joint venture. And given that the management also mentioned in their announcements that they are aggressively looking for properties to acquire for this Koliwu portfolio, we can expect more of such announcements in the coming months. So under both Work Plus Store and Koliwu, they have flexible lease terms and affordable rents depending on the location and the room type. The picture in the middle is an example of a room at the Koliwu property at Keppel Road. So that's all for LHN. I will now be moving on to Koda. So Koda is a manufacturer of wood-based home furniture for the living, dining, and bedroom. And this exports to the US made up about 60% of FY21 revenue, as we see the value of US furniture imports surging after the start of the pandemic and remaining above the pre-COVID levels, as you can see from the dark blue bars. So the company is riding on this furniture boom in the US, also due to the prolonged work from home and study from home trends, as more people are changing out of their old furniture or purchasing new furniture. So as we can see, the demand remains very strong, but on the production side, there have been some disruptions due to the pandemic restrictions in the factories in Malaysia and Vietnam. So for the Malaysia side, they have since resumed operations at 100% capacity since early September. But for the Vietnam side, just last week, they announced resumption at 50% capacity. And given the rates of the ramp up of the, given the rates of resumption of the operating capacity, which depends on the vaccination rates, I think it would be reasonable to say that we could expect resumption at full 100% capacity before the end of this year. And the last stock catalyst for this stock would be the expansion into manufacturing of sofas. So that's all for Koda. I will now be passing the time back to Natalie.
Thank you, Vivian. So my first stock pick will be Ascott Residence Trust. And first of all, the first reason why we like Ascott is because of its diversification by lease type and by geography, which provides some stability. So in the graph on the left-hand side, you see that, in terms of gross profit breakdown, there are three types of leases. First of all, master leases. Second, MCMGI. So these two lease types are the stable leases because there's a minimum rent collected. And then we also have the management contract, which provides the growth or the more variable type of rents. And in FY20, when it was a pandemic year and a bad year for hospitality, we see that the master leases and the MCMGI really came through for Ascott, providing almost 70% of the gross profit. So moving on, as we eye recovery, we expect the management contracts to start to pull its share of the weight, and master leases correspondingly will fall. Okay, so second of all, we think that Ascott will have a potentially faster recovery than its peers, and this is because 69% of its assets are located in countries where there are large domestic markets. So as international borders slowly reopen, these countries with larger captive domestic markets, where domestic travel is lifted, they will benefit first. Thirdly, Ascott is targeting to increase its long stay portfolio of PBSAs, which stands for purpose-built student accommodation assets and rental housing assets, to 15 to 20% of the AUM. So this year itself, they've already picked up two of such assets, and these assets are very special because they maintain a high occupancy of above 95% throughout the cycles. Even last year, occupancy was above 95%. So this helps to add stability for the portfolio. Lastly, Ascott has a good track record of asset recycling, and they have managed to sell assets at exit yields of about 2 to 5%, and they have reinvested these into higher yielding assets, commanding yields of 4 to 6.5%. So currently the undistributed capital gains stands at about 300 million. Okay, next slide, please. Second of all, Fraser Centrepoint Trust. So we like Fraser Centrepoint Trust because of its portfolio of suburban malls, which are resilient despite throughout the cycles. And this is due to, number one, the proximity to households, and of course, the recurring and necessity-driven spending that occurs at these suburban malls. 54% of the gross rental income is actually from essential services such as food and beverage, supermarkets, your health and beauty like your pharmacies, and some ancillary services like hairdressing. Okay, so in the graph on the left-hand side, we see that FCT has actually managed to sustain recovery above the general market. And we think this is also because of where they are located, being suburban in nature. Okay, we also expect the demand for space at suburban malls to remain strong due to the captive population, and larger malls, such as those within FCT's portfolio, will be prioritized amidst retail consolidation and expansions. Next, moving on to city developments. So we like city development because currently, we are experiencing a property upcycle, and CDL has a development pipeline of 1,700 over units, which will come online over the next 1 to 2 years. So this translates to FY 22 and 23 gross developmental value, GDV, of about $2.1 billion and $1 billion respectively. In the graph on the left-hand side, we see how CDL's residential performance over the past few years, being FY19, FY20, as well as the first half of 2020 and first half of 2021. So these numbers are actually CDL plus the JV partners. Yeah. So as you can see, there has been a recovering momentum, especially first half of 2021. Second of all, is the impending recovery of the hospitality sector. So the hospitality segment actually contributes 15% of EBITDA for city developments. Okay, so as the hospitality sector recovers, we also expect CDL's earnings to recover. We project 20% revenue CAGR for FY21 to FY25, and we expect this segment to turn NPI positive in FY24. Thirdly is CDL's ability to monetize its assets and to replenish its dry powder. So CDL has applied for the listing of UK commercial S-REIT, of which they will be a co-sponsor, and they will be injecting 2 of their London assets into this portfolio, being Aldgate Street as well as 125 Old Broad Street. And this could unlock $500 to $600 million for CDL. And of course, CDL currently is trading at an attractive valuation, 50% below our RNAV per share of $14.14. So we think this is relatively compelling. Okay, so that's all for CDL. I'll now pass the time on to Terence.
Thanks, Natalie. And good morning, everyone. For Keppel Corporation, there are just two main investment theses for the company. The first main investment thesis is the two MOUs, that non-binding MOUs that Keppel has signed to exit the O&M segment. While nothing has been confirmed, we expect a resolution in the fourth quarter of 2021. The second main investment thesis for the re-rating of Keppel is the acquisition of SPH SPH. So the SPH shareholders are set to vote on the proposed acquisition by Keppel in October or November. The acquisition will accelerate Keppel's plans, asset monetization plans for the rest of the next 3 years. So for us, the move away from the rig building business into an asset-light business, together with a 15% target ROE, as compared to their ROE in the last 2 years, which is really dragged down by the O&M segment, we believe we'll see a re-rating of the company. So we have a buy call on Keppel with a target price of $6.28. That's all from me. I'll hand back the time to Paul.
Thanks, Terence. Just 3 more last slides on some of our stock recommendations. So we still like ComfortDelGro, although it's been some time we've been recommending this. And I'll just run through the bullet points. So the first thing is the taxi rebates will be a short-term impact. I think what we see in September with the restrictions again, I think they have to continue with some of the taxi rebates. So the reasons why we like it is the recovery. So as the reopening happens, we think there'll be a recovery, and there is operating leverage in the business. And not to mention, they came out of this pandemic with an even stronger balance sheet, with a 500 million net cash. I think before that it was probably about 200 plus kind of net cash levels. So that's number one. The second thing is the whole restructuring. What is happening is that most MRTs are under this NRFF2. Basically, just a fancy word of the government will share with you some of the passenger risk. So right now, for downtown line, SBS Transit or Comfort basically just pays a fixed license fee, regardless whether there's no passengers or there's any or there's passenger traffic above their forecast. But under the NRFF2, they will share the ridership risk with the authorities. And just to note, even before the pandemic, let's say you take 2019, even with even when the normal traffic flows, the downtown line was already losing about, I think, at least more than 40 million. And from the authorities' point of view, this is not a sustainable model where they keep on losing money even during pre-pandemic levels. Sorry. The last point is just, of course, we are no illusions. I think we know that Grab is a formidable competitor, but we just want to note that ComfortDelGro pre-pandemic was trading around maybe 250. So now it's 150. So we're not like, our target price is only 180 something. So we're not like assuming it goes back to pre-pandemic levels, but we think that it's a bit underpriced considering the recovery is occurring hopefully, and also we have this restructuring angle to it. Next slide. Okay, move on to HRNet. So HRNet is one of the largest recruiter of flexible and permanent hires. The first reason why we like it is purely the attractive metrics. Why we say ROE is above 100 is because their share capital is roughly 100, and their net cash is about 300, and their net cash is about 300. And they definitely don't need so much cash on the balance sheet. It's mainly for M&A. So what we're trying to say is that to sustain this kind of earnings, they could technically pay back half or all the cash, but depends on whichever choosing you want. But what ultimately it just means that their ROEs are definitely more than 100%, if you want to compute it that way. The other attractive metrics is, like we mentioned, they have a 300 million net cash on the balance sheet, which is I think 40% of the market cap. And this is a very asset-light business. As you notice, the fixed assets is only 1.3 million, which is, I guess, mainly servers, computers, maybe some printers. To make, I think their profit is about 70 million plus. So what we like it is the attractive operating metrics, which I think the only company that comes close with the asset light is like Propnex. The second thing is, the reason why they have this is because they are a very formidable competitor. No one is going to let you enjoy such a high ROE unless you have very high, we have barriers there. So what we think is the barriers is the scale and also their track record, especially when meeting the requirements of some of their large clients, especially for some of these niche roles out there. So that's the first point. The second thing is that we are enjoying a huge upswing in hiring activities, a bit of pent up too. So they will benefit from the volume and also from the salary increase. The volume you can see on the table, the chart on the left. So this is the number of vacancies. So the blue line is vacancies for all jobs, which is a record high. You can see about 90,000 plus vacancies. But of course, some would say, no, these are lower end jobs. So if you look at the red line, which is the vacancies for PMET, more the managers and so forth, you can see it's also at record highs. And so what is the orange line basically means there's 163 vacancies for every 100 unemployed. So there are more jobs than people who are not working, I mean, in a nutshell. And the fifth bullet point is just the first half results. You already seen some of this recovery with a 70% jump in earnings. So we have a buy recommendation. Next slide. Oh, so this is our last slide, which is Q&A. I saw one question out there, so I'll address it later. So this is the largest dental chain, but even largest, they're only like 10% market share, roughly. So what we think is that third quarter will still be strong. If you look at the blue line over the red line, so this is calendar. So this is the blue line means the industry attendance in for 2021, and the red line is 2020. So you can see that in 2020 in May, of course, with circuit breaker, everything collapsed. But now that things are more normalized, you can still see that the blue line is still above. So the key is whether the industry can go above pre-pandemic levels. But even then, I think their volume should be above industry because of their expansion, and they should be taking market share. The next one is of course the second thing. The fourth bullet point is that we like it because the key for us is the increase in dental chains. So this will make growth more sustainable. The final one is just the COVID-19 PCR test. So the stock is a bit derated because most of us, including me, I mean, wrongly, of course, we kind of valued them at very high valuations. But after the Alcin deal, we, of course, brought back our valuations. We are probably taking them at like 10 times PE, 8 to 10 times PE for their PCR business, where we were valuing it at more than mid-teens, which were a bit too aggressive, obviously, because when after the authorities announced the endemic stage. So that kind of derated the stock a little bit. But for us, the thesis is still intact because it's all about the dental and expansion of dental clinics and chains. Okay, next slide. So this is our last slide. Just to conclude, we think inflation, while it's not run away, will persist, and it will put a lot of upward pressure on interest rates. Secondly, is that we still believe in exposure to the reopening themes and even international travel. The STI equity valuations are fair, but again, it hasn't priced in the border reopening. And that's our target, that's a rolling 12-month target. I think next slide. This is our team. Next, so for those who want to join our Telegram, so this is our Telegram. If you want to get our reports pushed to you by Telegram, and this is the broadcast channel. So this is you don't actually have to type here anything. It's not a chat group. So it's just a broadcast group. And from there, you will get our reports and also all our events. I mean, we have quite a number of LISCO events usually, so you will get a notification of that. So with that, thank you everyone for your time. I think we can take on the Q&A. I think Viren, you want to start first? I think I saw some for you.
Okay, yeah. Thanks, Paul. So yeah, just give me a moment while I just share the screen. So I see a couple of questions on UMS and then a couple of Hong Kong counters. So let's start off with UMS. I think UMS, there's one more further downside going on. First up, I think you look at the ADX. ADX is picking up, means that the downtrend is very strong, rebounding from 20. So if ADX is good, the ADX average is going to go up, means that the downtrend will be strong. And judging from the price action, we are seeing perhaps a retest of at the support, immediate resistance turn support at 1.46 to 1.49 going forward. So this is the outlook for UMS. I think same with the AEM. I think the semiconductors is going through some sort of correction right now. In the US, is also exhibiting same sign of signals. Right, for the Hong Kong 189 counter, definitely is on a downtrend now. First of all, the Ichimoku is showing a bearish trend, especially today's sell down has really triggered the Sego Span A to cross, form a bearish Kumo twist. So likely we're going to see price go hit to $10 to $12 region before rebound, and it's based on the ATR as well. So likely any near-term rebound won't see any passing above $17.35. Okay, so now move on to Hong Kong Tech. Hong Kong Tech, there's like a potential double bottom, but however, you have to take note that the potential double bottom means that we in order to clear the double bottom, we need to clear above the support resistance at $14.68 to $15.90. This is the major resistance that we have been looking at. Despite that, I think if price is going to edge 2 period higher above the Kijun Sen, then we are confident that that the upside target to 14.68 to 15.19 is there. But otherwise, I think is right now a very crucial period as well. So let's look out for this. Okay, so for Thai Bev is actually doing much better. Price return back to the support zone at 0.635 to 0.650. Upside target remain at 710 to 715. Whether you will break, not likely at the moment, as the ADX is showing a very slow momentum, trending below at 20. So when ADX is falling, it means that the strength of the trend, either bullish or bearish trend, is weak. This trend it is a very range bound momentum right now. Okay. So I'm moving on to Raffles Medical. Raffles Medical, we test near $1.50, so it's close price at $1.49. Consolidation, but it's not doing that well, despite the Ichimoku showing an uptrend. But you can see that prices and candles are edging closer to the signal indicator. Means that likelihood there will be a correction coming. And at the same time, if the correction do happen, it's going to be a very range bound market for Raffles Medical. The QM Dental definitely is going on a downtrend right now. Initially break off the channel, but the resistance zone at 0.60 to 0.625 is looking a rejection over here after forming a hanging man alike candle. Then there is a bearish candle sell down that closed, that opened below the Kijun Sen. If it close below the blue color Tenkan Sen, then we are seeing a further downside, a slight downside to further for QM Dental. Then look at SIA. I think upside. I reached you a report on sets as well. So I'm going to take sets as an example. So sets, I think, looking closely, it is near to my target price one, but this candle, this sell off doesn't look very good. Lastly, I think someone asked about the hourglass. Hourglass is not very good. Ranging, lack of momentum. I think ADX is showing a downtrend as well. So we are seeing not a very fantastic thing going forward. So last one is OIO. The upside definitely look attractive, but there's like a head and shoulder formation right now. So I think upside is here. If you look at the intraday price action consolidation, if it successfully break above 0.64, then we are looking at 750 for the next target. But however, should there be a rejection at 0.75, then we are looking at a downside correction to 410 before a rebound. All right, so that's all for my sharing. So I'll pass my time back to my colleagues for further sharing. Thank you.
Yeah, I think I'll take the next top rated question. Can you give your latest update on Sam Marine, and with their cash offer, if you own Sembcorp Marine shares, what would you do? I think there are a few questions on Sembcorp Marine in the queue, so maybe a little bit of background will help. So there's currently a mandatory general offer on Sembcorp Marine under the takeover code. This MGO for Sembcorp Marine will last until November. So shareholders of Sembcorp Marine have until November to decide whether to tender in their shares. Early November to tender in their shares. The offer from Temasek is for 8 cents a share. So at this moment, with for Temasek, their intention is not to delist the company, even though under Rule 723 of the takeover code, if the free float of Sem Marine fall below 10%, then Temasek will then have to take Sem Marine private. We think that likelihood is very small because the current share price is higher or around the mandatory general offer that Temasek has set up there. So we think the likelihood of Sem Marine being taken private is very low. You're talking about over 50%, 52% of free float that is in the market now, and about 40 needs to be tendered to Temasek. So we think that likelihood is very low unless there's a very, very sharp correction in the market. I think like what Paul mentioned in the earlier presentation slides also, there's a rebound in the oil prices, and that could be, and the house view is that we could see is still a little bit uncertain because capex, oil capex is a second derivative from rising oil prices, right? You need oil prices to rise. Then the oil majors will then increase their capex. So it will take time for the oil majors capex to come and for it to then flow into the order books of Sem Marine and Keppel. So we believe that there could be a rebound, but in the near term, the share price will likely remain low because of the uncertainty now with regards to the merger with Keppel O&M. So what is the forward view then? The forward view is that we could see a rebound, and if in 2022, especially with oil prices now hovering around $80 US dollars, and if they do merge with Keppel O&M, it means the transaction does go through. No certainty yet, but if it does go through, then we are potentially looking at a mega yacht being created, and with order books currently between the two entities above 7 billion Sing dollars. So that will put the new entity in a very good state. But investors will need to take a long-term view because this merger is not something that will happen in the next few quarters. It will take probably 2 to 3 quarters before this will come to fruition. And for full year 2021, Sembcorp Marine is still expected to make a loss. So that is the challenge. Of course, the worry now is for the downside for Sem Marine now is that they could do another rights issue to take over Keppel's assets. So there could be downward pressure on the share price. But there's no certainty yet because we don't know yet how they're going to fund the deal. Yeah. So sorry for a very long answer because I see some of the questions here. Most of the questions here are on Sem Marine. But let me know if I answered your question. Thanks. So I'll move on to see if there's any other questions for me. Okay, so there's one here. Does the increase in energy costs have any impact on Sembcorp's profit in UK, India, and China? The short answer to this is yes. It's difficult to quantify the exact impact on Sembcorp's profits now because a lot of it is still being priced in. We speak to the investor relations team. It's also difficult for them to project anything. But the way to think about this is when you see such spikes in energy costs, you see near-term volatility rise, and that has an impact on the spark spread. So when the spark spread increase, then because most of these costs can be passed through to the consumer through a formula that is imputed by the company and the merchant and the consumers. So this then leads to higher price because of the higher spark spread. So that has a positive impact on their margins and then their profitability. So the short answer is yes. Let me just continue to go down. What's the risk if we don't take the SAM Marine? What's the risk if we don't take the SAM Marine offer? Well, there's no risk. I mean the risk, the biggest. The biggest risk if you don't take the SAM Marine offer is that the share price could also take note that we have no coverage of SAM Marine. So this is just our house view and opinion, because we don't have any rated coverage on SAM Marine. But the risk obviously is at the expiration of the MGO offer, which is in the early November. If you need a date, I can get back to you. But which is in early November, then the share price will go lower than the 8 cents. So that for us is the bigger risk. Okay, I think that's all for me. I'll pass back the time to my colleagues.
Natalie, you want to take the Capital DC?
Hello, sorry, yes, okay. Yeah, I'll read out the question. Capital DC read any future growth and price factored in? I'm guessing it's in, okay. Okay, so for Capital DC, our target price of $3.20 actually already factors in 500 million worth of acquisition assumption for FY21. So currently, Capital DC for this year itself, they have already announced almost 200 million worth of acquisition. So we're about 40% there. However, of course, these acquisitions came in earlier than expected, which means that they will contribute more to this year's they will contribute more in comparison to our forecast, which was 500 million to come in the fourth quarter. So I think all in, net, it will sort of balance out a little bit. Yeah. So I think we're still on track to achieving the 500 million acquisition for FY21. Okay. Yeah. So I think I'll just briefly talk about some of the potential upside that we see for Capital DC. I think I mentioned this a few times. Capital DC, 70% of their revenue is actually from Singapore, and these leases in Singapore are actually the co-location type of leases. And even though there is talk about the data center moratorium being lifted this year, and by the end of this year, even if it does happen, it will still take some time, 2 to 4 years perhaps, for new data centers to be built. And because of the relatively shorter WALEs for these co-location type of assets, Capital DC's co-location assets, they are actually coming due, over the next 1 to 2 years time. And that means that there's still potential for rental growth for these 70% of leases that are actually in Singapore. Yeah, and of course, there's that component of the inorganic growth which I mentioned earlier, which we have already factored into our share price. Yep. Okay, sorry. Let me pull up the rest of the questions. I'll just scroll down. Next question for me. Okay, which is also on data center. So the question is your view on current share price of REITs with data centers. Yeah. So for the REITs with data centers, the pure play would be of course Capital DC, and Mapletree has mostly shell and core or fully fitted kind of leases. So these leases there's less management component to it. It is largely a very stable kind of lease with like 10 over years kind of WALE. Similarly for Ascendas also has some data centers in their portfolio. So the percentage of data centers in the portfolio will be number 1, Capital DC, number 2, Mapletree Industrial Trust, and then after that, Ascendas. Yeah, so for the data center REITs, yeah, I think mostly, like if you look at Capital DC, I think the share price has been relatively sideways. Currently, the price to NAV is about two times price to book. Yeah, and that has of course come down from about 2.5, 2.6 that we saw earlier in 2019. Yeah. And I think that there is upside for these REITs with the data center, especially because the data center are obviously a more hotly demanded kind of asset type. But that also means that it has the competition for these assets has been on the rise, and that also means that it could become increasingly more difficult to actually find these portfolios or these little pockets of accretive data center acquisitions. This will mostly affect Capital DC because their portfolio is already relatively efficient. They've already unlocked as much as they can unlock in terms of AEIs and value add to their portfolio. So the only way for them to grow would be from inorganic growth acquisitions. I hope that answers the question. Next question for me. With announcement of additional VTL, vaccinated travel lane, which stocks are a good buy? Okay, so just as to provide summary, the newly added countries on top of the Brunei and Germany that was initially announced is Canada, Denmark, France, Italy, Netherlands, Spain, Britain, United States, as well as most recently South Korea. So for these assets, for these countries, I think number one, the country that will benefit the most, of course, would be Singapore, because there will be more inbound travelers. And just for reference, a total almost 2,000 visitors from Germany and Brunei reached our shores since the 8th of October when the scheme actually kicked in. But this number is actually really minuscule. If you compare it to 2019 figures, this is actually about 0.01% of our annual visitor travel arrivals. I mean, yeah. Okay, so of course, number one, Singapore, because that we can expect more travelers into Singapore, but also other hospitality REITs that have assets in these countries. They will include Ascott, because Ascott has exposure to France and Italy, significant exposure, as well as the United States. Yeah, and other than Ascott, CDL also has some assets in one asset in Germany, and 6 assets in Singapore. FEHT, their portfolio is predominantly Singapore. Yeah. Okay, sorry. For Fraser Centrepoint Trust, they have 4 assets in the UK and 1 in Germany. So that should also help them slightly. But I think the one with the largest exposure to these countries would be Ascott. Yeah. Next question for me is, do you have any visibility on the confirmed REIT IPO listings in the coming 3 to 6 months? So initially, we were hearing talks about CDL's UK commercial REIT, and also Digital Realty's data center REIT, and I think also SPH student housing. So on top of these 3, we have first-hand information that there's another REIT coming. I won't mention it, but I think so far the process has been the fundraising process has been a bit slow. So we've been hearing talk about these REITs potentially listing in the earlier half of 2021. So not sure what is causing the delay, but that's as much as we can say. Okay, I think that's about it for me. I will just pass the time back to the rest of my colleagues first.
Yeah, in terms of the other stocks, if you reopen, it's obviously stocks like Genting, that will be the ones that will benefit from the reopening. To a certain extent, even the telcos will also benefit. And of course, the malls in the Orchard Belt, so those will be some of the like SPH REIT, Suntec. If you open up for MICE activities, these are the worst hit ones. I think if you want to play the highest beta mall or to a reopening, if you want to play the REITs, it's going to be Suntec, because Suntec has the mall which got hit quite badly, and they also have the MICE So there's virtually no exhibition, so they get hit. But so if you want the highest beta play for reopening for the malls should be Suntec. Okay, let me just run through as much as I can. Is SQ fully priced in for reopening? I'm not sure the exact valuations, and it's hard to pen down valuations because if you do a reopening, like how much earnings going to be uplift. But I think for SIA, it's all about. I mean, to be practical, but it's all about momentum and news flow for this stock. I mean, SIA market cap was bigger even before than the whole pandemic happened. And as you know, SIA was already quite a challenging business, considering it was already quite challenged even pre-pandemic with all the competition. And competition hasn't gone away. I think most of the airlines have got a lot of support from governments. So competition is still there. It's not like there's been some consolidation among airlines. So then you can have a more structural team behind SIA. I think the Emirates is probably going to be even stronger with the higher oil price, the Middle Eastern airlines. But again, this is purely just buying on momentum, reopening as more news of more countries. I think the next should be Japan and Australia VTL. So then that could take the SIA share price another leg up. And it's purely momentum until when you hear more and more countries reopening and the share price don't move, then you think it's kind of like already priced in. I think it's more of a trading stock rather than any deep like fundamental angle to it. Because we're always troubled by the amount of competition in the airlines, because their SIA is squeezed by the low-cost carriers at the bottom and then squeezed at the top by the Middle Eastern airlines. So they're like basically squeezed everywhere. But again, this is just a purely momentum thematic play. I hope that helps you. Admittedly, I don't really cover SIA. Let me just read out the next one. Possible for the banks to benefit from the interest rate hike. Glenn, can you help out before I add in some higher interest rates?
Yeah, thanks, Paul. So for the interest rates, I think mentioned earlier regarding DBS, similar for the other banks. So they all have this excess deposits. So it's quite large. For DBS, it's 59 billion. And with this rise in interest rates, the banks would be able to earn a larger interest from this excess deposit. So we have shown the graph as well. It actually matches. Let me bring up. Never mind. So they actually it closely related to the interest rate. So with a rise in interest rates, yeah, we do definitely expect that they will do better because it will allow for larger margins and more profits on their loans and financial transactions. And I think there's one more question on the banks. Let me see. Which local bank is a better investment? Why? It was earlier, and I think this was before I presented about DBS, so that's our pick. And it would mainly also be because of interest rates tailwinds, as well as their boost in their fees and commissions and the wealth management, and also loan growth and the dividend yield as well. So I think that would be it for me.
Thanks. Just to add, as Glenn mentioned, when interest rates rise, there are very few portfolios that have variable rate loans like banks. So banks know when interest rate rise, they can price higher their loans. That's number one. And like Glenn mentioned, there's also a float. So excess float, like I think in his slide 50 billion. So somewhere like DBS got huge amount of float where they just have more money than they can lend out. I mean, I wish I had that kind of benefit, but their excess, like I think 50 billion, I think Glenn mentioned. So this money will just automatically go to the bottom line when interest rates rise, because this money is basically lent out through the interbank or maybe parked with the central bank. So these were the automatic beneficiaries. Yeah. And the other one is also SGX, because SGX has a huge float. SGX also has about, I think, a 13 billion float. The float is probably less known because when you're buying into all these derivative products, there's always open interest. That means you got to keep overnight position. And SGX, of course, not going to take the risk. They want the clearing brokers or the clearing derivative houses. No, you better park some money with me before if you want to keep some overnight position. So this is also like money they float, and they actually earn quite a bit of quite a huge sum of money from all this, because they earn the interest from all this float, which got hit badly because of the interest rates. Although the amount of float actually was rising, but the income from the float was down because interest rates were down. No fault of theirs. So that's another beneficiary. Let me just run through one or two more. There's quite a lot actually. Hi Paul. The Prime Minister's announcement seemed to result in the drop of price of KNM today. Please share your views. if you listen to the ministerial task force, I think the most critical one for me was the emphasis is on ART, antigen, and the rationale is that the way the virus mutates now is that you get a huge viral load in the early stage. The weakness of ART was that it didn't capture enough. What you need, it wasn't sensitive enough to capture the virus compared to PCR, when you go standard, test the DNA of the gene. But what happens now is that because of the Delta strain, the viral load is huge in the beginning stage, and the authorities' viewpoints that the ART is good enough to catch the viral strain. Obviously, this is not good news for PCR. But although PCR will still happen, but I think the frequency won't be so high. I think the government seems to be tilting. I think it's quite obvious, right? They're giving all of us ART tests, and they're saying the ART test is good enough because it can catch the viral. Because the sensitivity not high, but I think with the amount of viral load, which is so huge, you can catch it. But we still have a buy call, mainly because we've already kind of downplayed the ART business, the contribution from PCR. We've already kind of parked the valuations at 60 million. We already kept it. Although the earnings will still be there, and we are, for us, the emphasis is mainly on the dental business. That's why we still have a buy call, and we think there's still earnings momentum in the at least the next 1 to 2 quarters. So that's why I think that's why the price of Q&M kind of declined. We are trying to get our SIM to come in to do a webinar. And then the doctor, hopefully the Acumen founder will be there to share with us. Now, we are trying our best. I think it should be soon, maybe in November. We try and get them in, and then everyone can ask all your PCR and medical questions to them. Okay, next one is dairy farm. We don't cover, but what happened was dairy farm got hit. Firstly, because 2020 was a very good year. So like saying, this year is big because we had such a good year last year in 2020 when everybody was pantry loading, panic buying. The other thing was that when the third quarter, when the pandemic hit, especially in Indonesia, they had to close a lot of malls. So they had, and also they have a lot of IKEA stores in Malaysia. Their stores in Malaysia and so on all had to close. So dairy farm is basically a victim of the pandemic and closure of a lot of stores in Southeast Asia, namely Indonesia and Malaysia. So if you think the recovery is returning, I mean, in these two countries, then I think dairy farm should be again. I hate to keep on saying this word, but it's also a recovery if Southeast Asia and Malaysia normalize. I hope that answers. Again, we don't cover. Just that I listen into their call and is Raffles Medical and UMS expensive going into 2020? For me, I'm a bit more worried about Raffles Medical because Raffles Medical, a lot of the recent boom, although they don't give you the precise number, a lot of it is due to all the vaccinations, all the PCR testing. So when that kind of dials down, we're just worried that earnings it may not jump, but it might just move sideways, or there's downside risk to the earnings. That's what we worry. The problem is that they don't give like how much comes from government, so we can't really kind of give you a precise number, but the risk is there, because you won't have that, and they will then depend a lot on medical tourism. At most, it will just fill the gap, and at most, it will just go sideways. And again, Raffles Medical, don't forget, it's all about how well their China operations do, which is still loss-making for now. UMS, I think is still, again, we don't cover, but we still think it's okay because the semicon cycle is still up. We think it could last until the middle of next year. Again, this is all guess because historically, I think in our presentation, historically, it lasts from 20 to 30 months. This time around could be extended. We are already about 18, 19 months. So we are probably 3/4 of a way to the cycle. So, but it still can be extended. AEM is also interesting because Intel has raising their foundry needs, because Intel used to, firstly, Intel never gone into graphics. So Intel is going aggressively into graphics, and also the way they manufacture has also changed. They're using a lot more wafer dies, not just one single wafer die. A bit complicated here, but they're using multiple wafer dies in their CPU. So that could actually help in the capex, and they're actually building 2 more foundries. So AM could be a beneficiary. Again, we don't cover this. Yeah, don't ask me. I guess too much of the workload. Let me just move on to the next. Is it the REITs? I think Natalie, if you want to help.
Hi. Okay. The question here is, with high prospect on increase in interest rate, what will be your best advice on the actions that investors should take on REITs? Okay. So in terms of the increase in interest rate, we don't actually have a house view on how the interest rates will move. However, we use Bloomberg consensus as an estimate. So the 10-year SGS yields were expected to remain below 2% up to 2022 before crossing the 2% level in 2023. So overall, we think that the DPU recovery or DPU growth for the S-REITs will outpace this growth in interest rates, number one. And number two, even if it hits 2%, this is still below the 2.3 or 2.2 to 2.3 average interest rate or the 10-year yields over the last 5 years. So in a nutshell, we think that there is still some potential for the REITs to actually grow their DPUs even in the near term, in the next 2021, 22, or even up to 2023. Yeah. And in terms of rising interest rates, so this will actually affect REITs in two ways. First of all, of course, the cost of borrowing. As we know, REITs are actually levered entities, and the average leverage is about 36, 38 currently. And so number one, it will hit the cost of borrowing. Number two, it may actually cause REITs to look less attractive compared to other kinds of equity, because REITs are frequently being measured. The dividend yield spread is a frequent measure that investors look at. So that will actually reduce the yield spread. Our advice would be to, for those who prefer a higher yield, they can always start looking at REITs with overseas exposure, or even 100% overseas exposure. The likes of Prime, even Core, which have DPU yields of upwards of 7%. Yeah, those are the kind of REITs that you can look at. Apart from that, I think there's also potential for the recovery play. So meaning to say, if you take a longer view, perhaps you can look at the hospitality sector. Apart from that, we also do like the industrials. As mentioned earlier, due to the exposure to the new economy sectors, which are the sectors experiencing growth, your tech, biomedical, manufacturing, and even your logistics segments. Yep. So that would be our recommendation.
Okay, let me just try and take some before we end it. It's already we got to end it at 12:45, but I saw some of those some of the questions that were asked much earlier due to the timestamp. Hi Paul, with rising inflation outlook, with which particular commodity sector which offers the highest upside potential? Hard commodity, soft commodity, precious metal, oil. I'm not particularly sure, because hard commodity, soft, it's pretty wide. But at least from the SGX point of view, I always thought rubber looked interesting, because the reason I'm saying that, when you play commodity, you're just going to buy what has not moved, what is like trading at the roughly the bottom. So someone like Halcyon, I thought I think trading almost close to their all-time lows, and rubber price hasn't moved. I don't know, probably the last significantly. I think the last 15-20 years, if I'm not mistaken. I mean, they bounced back up, but if you take it, the last time it traded this way was probably 10 years ago. So we think by 2022, I think if you were in the Halcyon call, the amount of planting in rubber, which was in 2010, the peak, most important is the peak, right? So the peak harvesting could be maybe in 2022, and from there it could decline. Again, one can only be hopeful. It's always quite it's like a minefield to try and forecast the precise time this thing can move. But with almost every form of commodity rising, I guess it's only hopefully this could also happen for rubber, which is underpriced. Now, even tin, like Malaysian smelting corp, nobody looked at it for I don't know, years. It's also starting to bounce back up because tin prices started to hit a record high. So that's I don't. That's maybe one other way to play commodities is buy those that have like kind of like trading at the lows. Okay. The other one, let me just try and answer this because we had an event with them. What is your recommendation for the newly announced Tuan-Sing bond 6.9%? We don't have a bond analyst anymore, but Tuan-Sing did a Powens webinar with us. We didn't have time to give you details. Hopefully we'll do it next week. But it looks interesting because they've got some very good assets inside Tuan-Sing. So like one of them is their Grand Hyatt in Melbourne, which was given an uplift in the GFA. So there could be a couple $100 million kind of revaluation gain if they kind of uplift and sell more office, turn it into a mixed use development. And these assets have been with them, I think almost 30 years. So these are like ultra prime office or CBD asset. The other one is also they have a Galtech. They have a Galtech which could be IPO'd also. And the latest valuation is they're carrying value about 300. The valuation for that, from what I understand, is I think more than double that. So I think they've got. I was quite impressed. I think they've got quite a number of assets inside Tuan-Sing, which takes some time to kind of peel and give some rough valuation. If we have time, I think we'll try and do that in the next weekly meeting. Anyone else can? Glenn, you want to take on the SGX before we end it?
Yep, sure. So for SGX, sorry, let me read the question. With the dip in SGX share price, can you give your view of what to expect in the next 12 months? So with SGX, they have quite a few new acquisitions. So we expect that to contribute to their revenue quite a bit. And these few acquisitions are expected to remain as growth engines for SGX. And I think just now Paul also mentioned about the float which they have, so that will also benefit from the interest rates rise. And actually their underlying business also remains quite resilient. And based on the last report, their revenue grew 7% year on year, which was actually lifted by their commodities trading volume, security settlement, and their corporate action revenue. Yep. Paul, if you have anything else to add?
Yeah, okay. Yeah, I think we're fine. I think in view of time, because we saw one question, what is the movement of Hong Kong Land price? Actually, the reason is they're doing a lot of share buybacks. I think recently they announced, I think 500 million, if I'm not mistaken. Okay. Which company produces ART? I'm not sure if, I know ClearBridge does, but I'm not sure it's under the approved, but it's being used by the MOH. Again, there's still lots of questions. Sorry, because of time constraint, we will have to move on, and you can either email us or just post your question in Stocks B&B here under the community page, and then we will try to answer them. With that, I'd like to thank everyone. We will resume the usual kind of corporate updates and so forth. Yeah. Sorry, might have bored some of you who already attended the Saturday briefing, but then we hope to see you again next week. And thanks for your questions and your time. Thank you, everybody. There's also a webinar RE&S tomorrow if anyone's interested, and also on Saturday we have our US strategy if anyone's interested. No, just go to the website at the bottom here, the events and seminars. Thank you, everybody. Have a good week ahead and stay safe. Thank you. Bye bye.